the buyer as to what to do with that home. And I know a lot of them probably will keep that home and maybe at that point turn it into a rental. So, there are still ways in which investors can utilize CMHC and Genworth and Canada Guarantee to buy properties at less than 20% down, but we just cannot do so with the intention right away of renting it out. Again, unless you are purchasing a duplex, triplex, fourplex, which you are moving into one of the units, there is a program for that.
Okay, let's just review that real quick. So if you're an investor, let's assume you're not a first-time home buyer. You're not, this is not your first property you're buying, and you're an investor, and you want to know if you can use insured mortgages or not. So some of the options you talked about are, you've seen it done with student rentals where mom and dad is buying the property with the intention that their child's going to move in while they're in school. And then when they move out, they would either sell it or turn it into a fully fledged student rental. If it is your first type of property, and if you qualify, you could move into a duplex or a triplex or a fourplex with 5 or 10% down, provided that, your story, and I guess you want to talk about that, makes sense that you're actually moving into the property or one of the units, or under the second home program. But, I don't want to say too much about that. I'll let you kind of handle that one.
Yeah. Secondary home program. It's a great program. I mean, it's always been a great program. A lot of people use it to buy vacation homes like cottages, and if they don't want to put as it pertains to the secondary home program, it can also be for family members in need. We have a lot of clients that have family members like a brother or sister who's not qualifying for a property that they're trying to buy. So then, maybe older brother, younger brother comes in and swoops in and helps out and actually buys the property using the secondary home program and purchasing it for their brother or sister. Much like, a parent could buy a secondary home for a son or daughter going off to university. So, it's definitely, it's all about intention. You have to really be careful. You don't want to be buying these, at less than 20% down with full intention of buying it as a rental, because the truth is that the banks, the auditors, they are doing much more work on that. They are trying to sniff that stuff out ever since Airbnb kind of came into the show. So, I mean, it's really just as long as you stick to the letter of the rules with regards to the programs and follow it, there is ways to certainly utilize these less than 20% down options for an investor, for sure.
So what if let's say someone like me who has multiple investment properties, who may or may not have used insured mortgages in the past, and let's say I want to buy a cottage now, can I still use it?
So the answer is technically yes. However, then it comes down to how many properties do you have? And we always have to be mindful of the fact that when you are applying, for an insured mortgage, so we're applying for a mortgage where we're putting down less than 20%, that's being reviewed by a mortgage insurer. So if we have, let's say I'm the applicant and I'm applying for the secondary home program, however, I own 4 rental properties plus my owner occupied, and now I'm wanting to apply and say that I'm buying a secondary residence. The reality is even if your numbers qualify, the insurer could simply come back and say, look, you're not eligible for our insurance. You're an investor. You have multiple rental properties. You have lots of equity. CMHC and Genworth and Canada Guarantee, their kind of claim is that they're here to help Canadians purchase real estate. And so when that's kind of their motto, they kind of fall back and say, hey, if you're someone who has, a net worth of $500,000 or more, or you've got multiple rental properties and you probably could put down 20% if you had to, then that's where, you could see them push back. But the reality is that technically you can apply, of course, but it's whether or not the underwriter at that insurer is going to be okay with you having that many properties. Say you have your owner occupied and you have 1 or 2 rentals and you're now buying a secondary residence. I couldn't see CMHC or Genworth or Canada Guarantee having much of a problem with that. But again, to your point, Paul, if you've got 5, 6, 7 rental properties and now you're trying to buy a secondary home at 5% down, I would sit here and say to you, I find the likelihood being low that you would get an approval, simply because the insurer would say that you're not eligible. You even though you qualify, you're just not technically eligible. That's all.
Okay. So so Sorry, crazy child break.
It's all right. It's all right. They're at a cottage. They're having fun, man.
Yeah, everybody but me. So if I'm an investor, realistically, then I'm looking at 20% down. You know, if I'm trying to use insured mortgages, then you know it's a very narrow criteria. And from what I understand from talking to you and Dan, the story behind it has to make sense.
Yes. Yes. You're 100% right. I mean, if I'm an investor and I'm wanting to buy rentals and I'm wanting to figure out a way that I can put down less than 20%, it's going to be tough. I mean, you're going to, you know, the insurers are not going to back you on that. I mean, and when I mean insurers, I mean CMHC, Genworth, and Canada Guarantee. They're not going to back you on purchasing a rental at less than 20%. So there are these kind of narrow ways that we can, you know, go about that, you know, maybe utilizing it something in the future. However, at 20% down payment, as we know, you can purchase, you know, multiple rentals and lots of them. You know, and I get calls all the time from investors saying, hey, I've found a loophole where, you know, I was able to purchase a home. Someone gave me a private mortgage for 80%. And then I got a second mortgage from someone else for another 10%. So I only had to put in 10% of my own money. I mean, I've heard these, you know, they're at the end of the day, finding a private mortgage lender or a lender that's going to provide you with a second mortgage up to 90% loan to value is just tough, especially in the COVID era. It's not going to be easy to find private lenders, you know, willing to dish out funds like that. So, you know, then we go back to really the traditional methods, which is, you know, the banks, when you're buying at 20% down or more, there are many, many, many programs to allow you to purchase rental programs. But yes, anything under 20%, I hesitate to use the words creative. I think you have to use the programs for what they are, which is there's definitely secondary home programs that you can utilize and purchase a secondary home. And then years later, you can maybe convert it to a rental. And definitely for those that are out there that are maybe first-time buyers, you know, and you're planning on moving into the home that you purchase, you know, that's where I would be looking at possibly buying a duplex, triplex, fourplex. I mean, you can buy a duplex with as little as 5% down payment. As long as you're moving in, you can then rent out the other unit. With triplexes and fourplexes, you can purchase them with as little as 10% down. Again, as long as you're moving into one of those units, you can then rent out the others. So there are little ways, but as you say, Paul, they're very narrow, and things have tightened up, you know, and they tighten up every year, unfortunately. I don't think we would see things open up again until we kind of reach the quote unquote bottom of the next kind of real estate cycle. Okay.
So that makes sense. So, you know, I'm not a mortgage broker, so I hear that I'm only get this through experience. So things have obviously changed since I first started. And now my conversation is to new investors who approach me about the 5 and 10% down thing. My conversation is, hey, look, it's a very narrow criteria you have to qualify. And if that's your only method, if you don't have the money to go to 20% down, then let's explore all the options and see what we can get. But, you know, don't bank on anything. But if you already have the 20% down, you might as well just go for it. And let's get this portfolio started before it's too late. I mean, every year we wait and, you know, you're losing out on appreciation and cash flow and all kinds of stuff. So it's not even for me talking to other investors, it's not even a massive consideration anymore, starting with 5 or 10% down. So I'm glad you confirmed that. Okay, so let's get to the real meat of it. So CMHC kind of did some changes recently. So for first-time buyers or first-time investors on the call, what's significant to them?
Well, I think the significant thing was the debt service ratio. So really, I'll kind of backtrack and I'll say that there were there's 3 big changes, but 2 of them are pretty substantial. The first one was that they cut back the debt servicing ratios. And what that means to basically the general public is that, you know, you need more income now to qualify for that same amount of mortgage that you were applying for. So say prior to the rule changes, or prior to July 1st when the rule changes will kick in, CMHC is now saying that someone who qualified for a $500,000 purchase price before at, let's say, 5% down, they're now going to qualify for actually, roughly around 440, 450 at the same down payment. Nothing changed. That's just now the new requirement. So basically, CMHC is saying, we are not going to let you use so much income towards the purchase of a home. So that was really the big one, because that had an effect of about 10 to 12% on purchase price. So anyone that was pre-approved through a lender that was planning to use CMHC, their purchasing power has now been dropped by 10 to 12%. Sorry. The other change was on credit score. They have now made the minimum credit score that you can apply with as 680. Previous to that, it was 600. So that 80 points on a credit score, that is a big change. However, a lot of people that were applying for CMHC mortgages, believe it or not, did have a 680 credit score. I would say it's probably going to affect about 10 to 15% of buyers that are out in the market today. They may not be able to purchase that same property now because their credit score doesn't meet the requirement. And the other one was that they are now targeting borrowers that are looking to borrow their down payment. They are not going to allow you to borrow down payment. You can still get a gift from a family member, but the idea of borrowing down payment from a line of credit or borrowing down payment through the means of a cashback that the bank may be offering is not something that CMHC is going to allow to do. Now, the cool thing about this, if there is a cool thing about it, is that there are two other mortgage insurers. There's Genworth and there's QnA Guarantee. And so far, Genworth and QnA Guarantee have said that they have no plans to adopt these changes. Now, I will just caution everyone on that, because I have been doing this for 20 years now, and every single time CMHC has made a change like this, the other insurers have eventually followed suit. Now, they may not follow suit right at the beginning. And there have been many times in the past they have publicly said, we are not following suit. But then ultimately 6 months later, 12 months later, whatever it is, we have seen the other insurers make the changes and match CMHC. And I have to tell you, that has happened for all 20 years that I've been doing this. So as much as I love the fact that Genworth and QnA Guarantee have said publicly that they will not be adopting the changes at this time, I think we need to wait probably until the next year to see if that will still hold true. But thankfully, if there are other insurers that are not making those changes, I can tell you that our office and many other good mortgage brokers and even good bankers will know how to submit a deal through to Genworth and QnA Guarantee. If you have a good relationship with your lender, you can actually have them direct the application to a specific insurer, not for any other reason other than that insurer will allow that application to be looked at, as opposed to maybe CMHC will not. So it's not like there's no infractions being done there. It's just having the ability to know which lenders will use different insurers and which ones will not.
Okay, so is QnA Guarantee the same as AIG?
Yeah, that is correct. They rebranded after the 2008-2009 fiasco. And so when they came to Canada probably just before then, and they were at the name AIG, and then when everything kind of hit the fan out in the States, immediately we got a memo saying they're now called QnA Guarantee, which goes by CG. So, but yes, I refer to them generally as AIG because that's who they are. So.
That's what I remember too. Yeah. Oh my God. Credit default swaps. Okay, got it. So if someone was on the threshold with CMHC and they lost 10% of their purchasing power, I mean, there's still an option to go, at least for now, to go to AI or QnA Guarantee or Genworth. Okay, makes sense.
There is, yeah. So far, so good. I mean, so I hate to say that CMHC's changes are going to have no effect, because I think that would be overzealous of me to say that. But I think if you're a wise mortgage broker, mortgage agent, or banker, you will figure out a way to get it to the other insurers, or at least try to get the other insurers to look at the file. There's a lot of times CMHC can decline a file, and then you just have, as a broker, you have a different lender or the same lender reroute the file to a different insurer. It's a standard, a standard thing that most good brokers can do for you. So.
Okay. Now, I raised the question about investors because I get the question, twice a week anyway, but I think we know the answer by now. But for people who are, looking for their first property purchase and want to leverage insured mortgages or, becoming a first investor, my answer to the first time investor is, if you're not sure if you're going to move in or move out or something, get yourself something with 2 units and, move into the basement, move into 1 unit and rent the other. You know what I mean? That's always my kind of advice to them, because even if you move in for a year and then move back out, that property's not going anywhere. You can always use it later, right? And if you can get through with 5 or 10% down, it's only to your benefit. But for first-time home buyers or first-time investors now, is there any specific advice you have for them regarding the specific changes or with insured mortgages in general?
I mean, with insured mortgages in general, I mean, I will say this. I mean, Paul, you and I have followed the same path from, 2 decades ago. Our first houses that we bought, I know my first house was purchased at 10% down payment. And within 3 years, I believe it was, I had then upgraded to a bigger home. And then I kept my original house that I had purchased at 10% and rented it out. And I know, you and Laura did the same thing. So, a lot of, I would say there's a very large amount of investors that their first rental was actually a property that they had purchased initially to move into and bought it at 5 or 10% down payment. So, my biggest advice to first-time buyers or first-time investors is, if you do have the ability to purchase a property at less than 20% down, do it. Because one thing we know as investors is that capital or cash is king. The more capital we have, it's kind of like bullets for our gun. Once we run out of bullets for our gun, what use is the gun? So, if I can purchase, if I'm a first-time buyer and at the same time I'm looking at investing in real estate, I think it goes hand in hand. You probably want to buy if you can, and if the numbers work out, and if you're coach and you have planned this out correctly, why not buy your first property at 5% down payment? You would then live in it for a while, and then effectively you would look to upgrade or move to a different property and then keep that property and rent it out. There's absolutely nothing wrong with that. And the other thing too is there's nothing wrong with then reapplying back at 4 or 5% down mortgage. So a lot of times, if I'm a first-time buyer and I happen to fall into this category of first-time buyer and I'm also a future investor, why not buy your first property at 5% down, move into it. Then a couple years, 3 years, 4 years, 5 years later, you now make a change and you're going to go buy a different property to move into. What's stopping us from applying at 5 and 10% down for that next property that you plan to move into? We will upfront tell the current lender you plan to rent out your current home. There is nothing illegal about that. If the insurer approves the deal and we've disclosed everything up front, there's nothing wrong with that. So, I mean, definitely there are ways to utilize it when you're starting out. For some investors that are not just starting out, they're going to say, Dave, this is useless information for me. And I would agree. But I mean, to your point, to answer your question of, if I'm a first-time buyer, first-time investor, and I'm in that, that kind of saddle, I definitely think buying at less than 20% down is smart, because we want to have, we're going to have to put down 20% at some point down the road as we continue on our real estate career. So if we have that capital, we haven't expended it all, on our first couple properties, then that's certainly going to help us continue the journey and continue to increase our portfolio holdings.
Well, I can say, same advice I would give, but from perspective, when I first got started, I needed 5% down because I was broke and I didn't have a lot of money. I was breaking, my piggy banks because I forgot to throw in the land transfer tax calculation. And Jerry called me last minute. He's like, dude, you owe me like $3,000 here. I'm like, oh shit. You know what I mean? So, but nowadays, whether you have money or even if you have money, the obstacle and the barrier is higher, much higher, because property prices have, doubled and tripled, or in some cases since, 2009, 2010, whenever it was that I bought my first property. So if 5 and 10% down is the baby step or the key that will get you into the marketplace, you like, sorry for the strong language, but you're almost crazy not to take it. Waiting for the perfect scenario isn't going to give you any benefit. You can always move in. And another obstacle I see is people from the GTA, West GTA, Oakville, Mississauga, or the city of the core, North GTA. they can't find a house in their general area that meets the criteria and their qualification level, because this, to get qualified for insured mortgages, the threshold's higher. They got to qualify at the posted rate. So they're getting qualified lower. You're still in your best interest to buy something a little bit further out, further north, further west, further east, further south, whatever it is, just to get in. Even if you have to move in for a year and then do what Dave's saying is do the move up. Stay there for 6 months or a year, wait for some appreciation, then go and do 5% and 10% again when you have some more income. Move up to a bigger house, sell the other one, turn the other one into a rental property. Just get in. That's the point. Get in, because it's not timing the market, it's time in the market that really kind of pays dividends here. You want to be in for as long as and with as much as possible. So I hope that kind of resonates for all the new buyers here. Now, there was a bunch of questions that came through the chat. I'm going to go. Someone asked if you can beat their rate. I told them I'd connect you by email. As a retiree, is it possible to get a mortgage with 20% down?
The answer is yes. Yeah, retirement income is counted exactly the same as someone who's on a salary or someone who's self-employed that's showing their income on their taxes. There's no difference. So pension income is 100% usable. A question I get asked a lot is, Dave, my mom's on a pension and she's 75 years old. Can she get a mortgage? Because the amortization is going to be, say, 30 years, and that would make her 105. Well, the banks are not allowed to discriminate based on age. They're not allowed to predict when someone will expire. So the reality is that we've gotten mortgages for people as old as, in their 80s, with long amortization. So pension income is completely counted just like anything else. Now, the obvious thing here is that most of the time pension income is going to be lower than what you may have been earning when you're in your professional career. And so, to that question, I can certainly tell you that, qualifying for pensioners can be more difficult simply because of the qualification methods. The income is usually a little bit less. So then they maybe don't qualify for exactly what they're looking at. But pension income is 100% usable.
Now, what about, this is a question I get all the time. What about those people, and a lot of times they're older, might be retired, but the people with lots of net worth, but no real kind of measurable income. And they always assume that, oh yeah, my house is worth $2 million and it's paid off, and I should be okay to get a mortgage. And it's like, well, maybe, but maybe not.
Yeah. I mean, 15 years ago, there were lots of programs for people that were self-employed and didn't have a lot of income, but they had high net worths. There was also tons of programs for people that just had high net worths. The banks were able to accommodate. And then, in the last, dozen years, we've kind of seen program after program fall off the map. And really, the sad truth is right now, the mortgage world, or we'll call it the A mortgage world, where we're talking about major banks and the lenders that are offering the good rates. It's really, a lot of it's predicated on income these days. Now that will change. I mean, there are cycles to this. When I first got started, it was like the era of the no income qualifier programs. You didn't really have to have income. You just had to show them the ability that you were making some income and you didn't make terrible decisions. And then of course we can thank the 2008, 2009, U.S. lending debacle for the tightening, that we saw, and multiple programs, being taken off. So the good thing I can tell you is there are still programs for high net worth individuals. They're certainly not easy to qualify for. A lot of times they're wanting to see liquid funds, meaning they want to see it sitting in like a savings account. And how many of our investors are going to be putting money in a 1% savings account? Not many. We're going to be putting our money into other things. So, the programs are kind of weird. They're geared towards a real small demographic of people, but these programs do exist. They're just not easy to qualify for. And a lot of people will tout that they're there, but I can tell you, as someone who does this every day, multiple files a day, there's a practicality that you have to look at. Yes, there's tons of programs that exist. What's the practicalness that these programs are even going to be getting out approvals. That's the one thing I can tell you in this business is there's lots of programs. But whether you get approved for the program is a whole different story. So,
Okay.
but they do exist, Paul. They definitely do exist. They're there.
Fair enough. If I have 20% down, how difficult is it to get commercial financing? So that's an easy one, Frank. I mean, the commercial lenders don't care about you and your income. They're going to qualify the property and the income of the property as a business. All they care about is the net income. So the gross income minus the operating expenses gives you a net income. And then they calculate what's called a DCR, a debt coverage ratio. And usually with a commercial lender, your debt coverage ratio has to be a minimum of 1.2, 1.25 or better. So that means for every dollar of debt service, you need $1.20, $1.25 of net income. And you can qualify. And you need some net worth qualification there. You can't just be homeless one day and win the lottery and then go get a commercial mortgage. It doesn't work like that. You need to see that you're a functioning part of society. But commercial lending is a little bit more straightforward, I find, even though it's the
Yeah, I mean, to add to that, I would say, in a weird way, there's definitely, there's aspects of commercial lending I don't like, and then there's aspects I love. I love the aspect of commercial lending where they're not looking at our income, our personal income. They could care less about that, as Paul says. They're more interested in the property, their security against the property. And what I mean by that is, is it a property that they want to lend 80% on, or maybe only 75% or 70%? And that's, so a lot of times commercial comes down to more the down payment amount and the property itself, right? Those are the two key factors in determining a lot of approvals on the commercial side, which is pretty much the opposite. When we talk about residential is all based on not the down payment, but more the income and the credit of that person. And they could care less. And even on the rental side on residential, the banks don't care so much about coverage on that property as much as commercial does. You have a lot of the residential lenders are just using offsets, 50% here, 80% there. So it's not a big thing. And you're also getting to use your personal income. Like someone with a high personal income, they can actually overcome a residential rental property that's not carrying a lot of rental income on it, because they will look at your overall income, your personal. Commercial does not do that, as Paul says. Commercial is strictly focused on the actual property itself and their security against it.
Okay, just to follow up on that. So commercial mortgages start most of the time above 4 units, so 5 units and above. There are a few lenders who do 6, 7, 8 units as residential, or 5, 6, 7, 8 units. But beyond 7, it's pretty much 98% of the time it's going to be commercial. Here's another good one here. Is there a required time period you need to remain in the house if you buy as insured owner occupied and then decide to rent it out later?
It's so technically there's no timeline. There's not a set timeline. It's not like they say you have to be in here for this amount of time until you can make a change in your life. And I think the reason they do that is because it's really tough. I mean, let's look at a real scenario where someone does buy a property at 5% down, and then they, 1 month later, their employer transfers them to, a whole different province. And they now have to pick up and move. Maybe it doesn't make sense for them to sell that property. So they're going to keep it and rent it out and then move, purchase a new property in the province that their employer has shipped them. So that is why the banks and insurers, in my opinion, don't put a time frame on it. But if I will say this, if you're looking to game, and maybe that's a bad word. I was going to say game the system, but if you're looking to take advantage of the language, there is no set amount. But I will say this, over the last 20 years, I can tell you that the banks and the insurers, they take that type of thing a lot more serious now. 20 years ago, I don't think there was a lot of people at banks running checks to see if people were living in a house that they had claimed they were living in. And maybe this is just a function of the time and people getting smarter and maybe more people taking advantage of the lackadaisical rules. But I can tell you that the banks and the insurers, they monitor that a hell of a lot more now. And you probably heard me earlier, I kind of blame a little bit of it on Airbnb. And not that I'm an Airbnb hater at all, but the banks specifically hate Airbnbs. They hate short-term rentals. So the kind of explosion of the Airbnb has caused, in my opinion, the banks and auditors and people at the insurers to take more of a notice of anyone that might be trying to take advantage of that language. And so, if you're getting my drift, what I'm saying is it's being monitored more. So if you are going to play that game, hey, there's no rules there that says you have to be in a certain amount, but I would just caution everyone to be careful if you are looking to kind of game it in that way. Just know that I've heard of banks knocking on doors to see if people are living there as they say they're going to. So.
Wow. Okay. I haven't heard that one yet. So that's interesting.
Yeah, I heard it's more of an Airbnb. Again, it really is more of an Airbnb thing, because that explosion. I mean, I have specifically talked to a audit guy at a bank, and he has told me that they have gone door to door, mostly back. This was like about a year ago. They were focusing on the Vancouver, BC market, and they were going door to door to see if people were actually living there, and finding out that they were turned into Airbnbs, and that was a big problem. So
okay. Here's one I can probably answer. The changes in mortgage qualification by CMHC, do these apply to 20% down mortgages? So I'm going to say no.
That is correct. Yeah, there is no change to 20% down mortgages at this time.
Okay, do you have to notify the bank if changing from owner-occupied to rental? I definitely hope not.
You're not. Again, nothing in the language states that. So therefore, technically, you do not. I mean, when you were buying a home and you were putting down 5 or 10% down, stating that your intention is to move into the home, and then certainly if you did move to the home, and I think you put to let them know. More so, you should be changing your insurance, meaning your coverage of your insurance should be changed to rental now. With it, I'm sure they can contact you, but I don't believe you're breaking any rules. There are no set rules on that in terms of time frame or.
Okay. Let me see if I have any questions here. Yeah, you were cutting out a bit there, Dave, but I'm going to see if I have any more questions here.
Sorry about that.
That's okay. That's okay. Okay. I think I covered what I needed to cover for people. So pump through your questions here, guys, if you haven't. Oh, here's one. I bought 2 properties, and the stipulation back in 2015 was that I was be living at the property. 5 years later, I want to purchase a 3rd property. And of course, lenders will want to see my rental income. Would I still be held to the stipulation given the time lapse if my broker passes out this information to any other lenders that I may have used previously? So I don't really understand that question, Liz. Are you saying, are they going to ask you for rental information on your purchases, on your previous properties if you're qualifying again? I'm going to say, yeah, definitely.
Yeah, I mean, if you have multiple properties you've purchased before, and again, you're going to move into a new property, as long as everything is disclosed to the lender, you're okay. And as far as rental income goes, you may not have your current home rented out yet, but a lot of lenders will take what's called a market rents analysis. So they will instead, you basically as a broker, you submit the application stating that my client will in fact be renting out their current residence and moving into the new one. And then you are allowed to submit a market rents analysis from an appraiser that states how much that property would be rented out for. And that's, as opposed to providing a lease. Now, certainly if you do get a lease, you want to provide that. But if not, then the broker should be able to use a market rents analysis.
Okay. How many years would you consider a principal residence? Well, I guess you're trying to ask how long does it take before the home you're living in is considered a principal residence? My understanding is 1 year, as far as from a tax perspective. But from a mortgage perspective, I don't know if there's a stipulation there or a definition.
No, I would agree. I would say there's definitely a baseline out there of 1 year, but again, I think it depends on changes. I mean, if my life has changed and I have now had to make a change in my life that's forced me to move to a different property and maybe rent out my current home, I do not believe there should be a time frame established onto that. To me, I just don't think they can do that. And I give always the example of, what if you had to change your life. You got married, and now your new wife wants to live in a different area. So you're gonna rent out your current home. I mean, life changes happen, and employment changes, personal changes. So if there's a change to your scenario that has forced you to now, make a change in your plans and rent out your current home and purchase another one, I don't believe there should be any time frame established to that or attached to that. But certainly, if you are planning and saying, hey, I'm going to purchase this as an owner occupied, and then I plan to rent it out and move to another one and buy another one, I would say minimum of a year. But if you really wanted to know, if you really, really wanted to know and be safe, you could call the lender. Get someone at that bank to put something on paper for you. And then you have this kind of certificate saying, this is my allowance. I mean, if someone at the bank's going to say yes to it, then in my opinion, you're okay.
Let me see from Raquel. Can we buy a sixplex and say we'll move into one of the units and get a 5% down payment?
Unfortunately, no. So the cap with CMHC to buy a multiplex property at less than 20% down, the cap is 4 units. So if you buy anything above 4 units, it's now ineligible for that CMHC owner occupied / rental program.
That's a good question, Raquel. I'm laughing because I wish it was true, but it's not. So sixplexes, you're definitely, depending on where you are, you're going to be 20% down with RBC or maybe at Desjardins, or you're into commercial for sure. Okay. Have you any insights on into the CMHC rules on the use of equity takeout money? That's for commercial.
Well, that's also the borrowed down payment part. So basically what they're saying is, at 5 and 10 and 15% down payment now, when you're buying a home, they do not want you borrowing it from, another store. They just don't want you using borrowed funds. So they are capping you. They're not allowing you to use a home equity line of credit. You would have to use actual funds. But there's ways to plan this out, I would say to you. If we know the requirement for the lenders when you're buying a property and for the insurers is to have the down payment in an account for 90 days. Once it's in an account for 90 days, it's not considered borrowed. So if I was wanting to plan out a move where I was wanting to use, let's say, money from a home equity line, I don't believe we're breaking any rules by taking the money from the home equity line, putting it in our bank account, letting it sit there for the 90 days, because that kind of crystallizes it and turns it into own resources. And that's kind of the way, we've asked banks this, what is your stance on that? And they've said, look, as long as it covers, our down payment verification rules, then we're okay. So there are ways to plan it, but yeah, certainly these rules have not been favorable for someone who wants to use a home equity line or a refinance or money from a refinance of a property to then purchase at 5 or 10% down payment. It's not helping at all.
Okay. So not even like a family thing, like when you used to get the letter from the family, hey, we let you borrow 20 grand. That's
well, you can get a gift. Yes. So you can get a gift from, you can get a gift from family members. So certainly, maybe that's the way, and maybe you, if you're getting gifted funds, that would be the way around something like that. But certainly you have to remember, when doing gifted funds, the bank is still going to ask for a gift letter. They're going to want to see the funds being put into your account. And they can always ask for verification that the funds did in fact come from the donor. So, I mean, it's always just being careful on that. But yes, definitely gifted down payment was not affected in the new rule.
Okay, cool. So that's it for questions. I'm going to make sure that we kind of respect the time limits here. Dave, what's the best way to get a hold of you or Dan at the office if someone wants to ask about, the best rates you got or refinancing or a first-time home buyer, whatever it is? How do they get a hold of you guys?
Sure, they can just email us. We have a very general email account that is handled by myself and Dan and some of the others. It's info@butlermortgages.com. Or you can certainly reach us by phone at 1-888-684-8326. But yeah, feel free to get in touch with us. Let us know that you're working with Paul, and we will make sure to take great care of you. I got myself, Dan Patton, Mike Zanzini. We have a crew of us that have been working with investors for many years now, and we're all investors ourselves. So I think that's why Paul and I have always kind of got along. We come from the same mindset. Paul's much younger and better looking than me, but certainly, we've been working together for a long time, and I enjoy working with Paul. And he's really, you're a wealth of knowledge, my friend, and you've been doing it, and your experience level is insanely high. You've done from single family homes to major multiplexes. So, you're even someone that I've come to in the past for advice on stuff. So I really appreciate the time and putting me on here.
Might be younger, but your cottage is better than mine. So
you'll get there, buddy. I'm scared. You young bucks are all gonna surpass me, man. That's how it goes.
I always said I'm never buying a cottage. It's too expensive to maintain, man. I'm just gonna show up at yours for one weekend every summer.
Hey, that ain't a problem. A rock star party up here would be very fun. So.
So for everyone else on the call, if you want to get a hold of me, my email is very easy. It's paul@rockstarbrokerage.com. You can find me on Facebook and Instagram. We have lots of fun with our social media. If you're a first-time home buyer, I got a real soft spot for first-time home buyers and helping young people kind of get in, or anyone getting in for the first time, because I had a lot of help getting in for the first time for people like Dave and when I started, and Mike and Rockstar and stuff like that. So I love to help people kind of get in the game. And if I help you when you're young and you do really well, I'm sure you'll be loyal to me for the future. So there's something in it for both of us. Okay, so I'll put my email in here again just in case. And if you want a recording of this, it'll go out to my my kind of VIP email list. This is Zoom, so when you register for this, I don't get your email. It's not like a webinar. So if we haven't met before, I don't have your email or phone number at all. So I'll put my website in here where you can put your email in and be registered on my email list, just in case you want a copy of this recording. So thanks to Dave. Reach out to him for your mortgage stuff, and then we'll be in touch soon. Thanks, guys.
Thanks, everybody. I appreciate your time.
Okay, Okay, the website's in there if you want it. Talk soon, everyone.
Thanks.